Hey, what's going on, guys? The Investor here, and welcome back to the Investors Hub, where we talk all things stocks, commodities, and macroeconomics to give you more information on how to make better and smarter investment decisions. Um, Today, we're actually going to be talking about where the markets are at right now, and boy, I gotta tell you that it is in a very, very serious predicament now. Definitely going to be talking and breaking down quite a bit here, but being very honest, we can see right now where we're looking at the S&P 500 over the course of the weekend. It's currently Saturday, and we are nearing all-time highs. We flirted with the all-time high of almost 6,300 on the S&P 500 index, with a high, I believe, of 6,280. Right, and now we're sitting at 62.59 as it currently stands right now, from headlines, basically saying, Dow jumps more than 300 points, S&P 500 sets new record after strong job reports. There are a number of things, whether it be data, strong job data, these new tariff announcements that, the president of the United States just announced today and over the course of the week, AI, tech. This is all of the things that we're going to be talking about, as well as geopolitical tensions that are going to be bolstering quite a bit of opportunity on the side of commodities, right? So there's going to be a lot that we're going to be breaking down, but first and foremost, I think what's important to really focus on here is that, as you can see, we have strong job data, and we can see how the markets have reacted in some aspect, way, shape, or form, based off of how the markets actually finished up um, towards preceding July 4th. So job data came out July 3rd, adding 147,000 new jobs, which I believe was higher than their regular estimates and everything, which came back with unemployment dropping below 4.1%, I believe. And of course, you have the markets doing what the market likes to do when it comes to news like this. It jumps up, but as you can see, it's not necessarily sustainable. Now, that's not the main reason why we're talking about this right now, but again, just to give an overall playing field understanding as to where the markets typically are at right now, I want to take some time to focus on where the overall markets are at right now as it currently stands. Let's take off logarithmic real quick. And as you can see, we're and this is the Nasdaq Composite. As you can see, we've made we've covered quite a bit of ground ever since Liberation Day from April 2nd. Right. So if you're unaware about what Liberation Day was, when President Trump decided to issue tariffs on the entire world, for lack of better words, and we're sitting at a very big resistance area, not only on the S&P 500 but the Nasdaq Composite, um, the Dow Jones Industrial. We're sitting at a triple top right now, and even when it comes to the European markets, right, whether it be the DAX, the German DAX index, again, we're getting some major and heavy resistance in some way, shape, or form, as well as the London index and the UK 100 also being the same thing, in addition to things like Japan as well. Right now, we're not going to get too much into the US dollar to Japanese yen quite yet, right? But one thing that is important to note amongst all of this right now is where the markets certainly are at right now in relation to the news that, once again, we just receive after the market jumps 300 points. Now, mind you, this was I do believe this was July 3rd. Okay, so again, this was probably about maybe 10 days prior to the current price action that we have now, and we still get that lag. But one thing that you'll one thing that you haven't probably heard about, that you probably should have, is that over the course of this week as well as today, the markets have dropped due to President Trump once again announcing tariffs on countries including Japan and South Korea. Now, before getting specifically into whatever countries, let's just take some time to break down how many countries were actually issued tariffs. Okay, here's the full list by Watcher Guru. The European Union 30%, South Africa 30%, South Korea 25%, Bangladesh 35%, Kazakhstan 25%, Philippines 20%, Cambodia 36%, Indonesia 32%, Myanmar 40%, Sri Lanka 30%, Malaysia 25%, Thailand 36%, Moldova 25%, Canada is 35%, Mexico is 30% on top of the baseline. This is basically 20 to 25% on top of the baseline 10% that they were given April 2nd on Liberation Day. Okay, so this is an additional 20 to 25% for these separate countries. Bosnia 30%, Algeria 30%, Tunisia 25%, Brunei 25%, Serbia 35%, Japan is super important, 25%, Brazil 50%, Libya 30%, Laos 40%, and of course, last but not least, Iraq 30%. And I will also say that this is important as well, right? Now, this is super important because, again, if you remember what happened last time when it came to the markets reacting to Liberation Day tariffs, essentially the markets dropped all the way from what seems to be about 5,600 points all the way down to about maybe 49, sub 4,900, right? And then bottoming, and then of course beyond that, once the tariffs were implemented and actually started rolling in, then the market started recovering for the fact that tariffs bring in more revenue to the United States, which essentially offsets inflation one way or another. Okay. And I like this. I like to think that many people would actually like to think that that's good, because you're essentially alleviating one problem. But what most people do not realize is when you do something to alleviate one problem, then there's a good chance that there's going to be another problem right behind it. Okay, so if you're unaware, what causes inflation is due to a lack of GDP, or the amount of money coming into a country in relation to the amount of spending or the amount of money going out of a country, and usually that comprises of government spending, right? And so you have more revenue being brought into the United States, which is great. This is the reason why we have inflation lowering. This is the reason why the prices of food is going down. But one thing that you also have that is looming above this, alongside of lower unemployment, higher, a stronger bolstering of job data, is the fact that you still have the biggest concern of all, and that is what in the world is the Fed doing when it comes to changing and adjusting interest rates, because of the fact that we have a strong job report. Okay. Oftentimes it does not and this is the reason why the Fed is oftentimes late, because they'll take time to look at data from previous months without being entirely neglecting what is currently happening in real time. So of course, yes, we are sitting at all-time highs right now. You have this, but again, all of these this second round of tariffs, in my personal opinion, is going to be something a lot more gruesome in the grander scheme of things than the initial one on April 2nd, and let me explain why. Okay, first and foremost, we actually take some time to come over here. We can actually take some time to look at the S&P, the P&E of the S&P 500. Okay, so if anybody is unaware about where the historical P&E ratio typically is when it comes to the S&P 500, it is usually around 19.48 to 24.5. Okay, and right now, and again, these numbers have fluctuated between your base of 25.55 as calculated on July 11th to even 28 or 29. But again, considering the last 5 years, an average PE interval is 19.48 to 24.5. And for this reason, the current P&E can be considered overvalued. So with all of these many companies, especially tech, with these high end evaluations and things of that nature, what between tariffs and between interest rates, because again, you got to be able to understand these tariffs put higher prices, higher control price, or not control, but higher prices on being able to buy whatever products, whether it be semiconductors, whether it be anything that these big tech companies need. It causes them to spend more, to have to receive less. Or it causes the other countries, excuse me, to have to spend more in order to receive less, right? And so the question that brings into play is, how in the world are these tariffs going to going to react, or rather, how is the tech sector going to necessarily react in a situation where you have another round of tariffs, especially when the United States currently right now is looking for trade deals. In addition to these tariffs on these countries, you also have a 50% tariff, issued tariff on copper. Okay, so you have a number of things that are actually being issued here. And if we can, real quick, I do believe, let's look at copper real quick. You can see that due to the issuance of copper, the value of copper is actually skyrocketed due to it, right? So the reason why all of these are important is because now you have a number of factors that are playing a major role in what's going to be affecting the markets this time around. And one of the main ones is actually the Japanese yen carry trade. As you can see, due to the announcement of the yen carry trade, we've had a very major rally in the Japanese yen. Now, for anybody who is unaware about the yen carry trade, the yen carry trade is something that has been done for quite a while, where individuals will go ahead and borrow the yen, and then of course go against the currency of yen, excuse me, borrow against it, and then convert the currency into something of higher value, because they have lower rates when it comes to their currency exchange. And what it is that will happen is that these individuals, these entities, these banks will go ahead and actually buy stocks, buy indices for a higher price. I mean, for a lower for a lower price, I believe. And I'm gonna go ahead and clarify this because I'm getting tongue tied now, right? In order to keep the price up for less. Okay, so I think what would be actually very, very, very important, I think we'll actually go ahead and just find the best way of allowing Grok to do this for us, right? But if you ever want to know what the yen carry trade is, explain briefly what the yen carry trade is. Okay. The yen carry trade is an investment strategy where investors borrow Japanese yen at low interest rates, convert it into higher yielding currency, and invest those assets like bonds or stocks in that currency to earn the interest rate differential or asset returns. The goal is to profit from the difference in the interest rates or asset appreciation, but it carries risks if the yen strengthens or the invested assets decline in value. You see, that is extremely important, is because now that you have America, the United States, putting more pressure on their goods itself, now you have the United States dollar and the Japanese yen starting to diverge. Okay, and again, if you're unaware about what happened the last time that the yen carry trade began to unwind, if you go all the way back to what I believe it was actually July of last year. Way before this, way before this, way before this. Here we are right here, right? July of last year, beginning of August, was when the yen carry trade started to unravel a bit, and it sank the markets from 5,500 all the way down to 5,200 sub in a matter of 3 days. Okay. And so now that we have all of these tariffs, and again, the whether it be the currency, whether it be costing more for people to get these due to these tariffs, again, this further increases the possibility of having the Japanese yen carry trade unwind once again as the Japanese yen in relation to the US dollar continually increases. All right. So again, whether it be jobs data, whether it be anything, again, this is these are the things that are, these macroeconomic events are what is actually moving the markets as it currently stands, right? Now, beyond that, we have other things like AI, right? So far we've talked about the tariffs. So far we've talked about job data, and we talked about interest rates beyond this point, right? But where does tech play a major role? Again, when it comes to borrowing against the Japanese yen, the investment strategy is to basically utilize the exchange rate differential to then buy stocks or bonds. And again, the S&P 500 is heavily dependent on the tech sector. This is why if we look at the NASDAQ composite currently right now, it is outrageous as to where it currently is, whether it be that or the Dow Jones Industrial. Okay, and if we take some time to actually zoom out, this could mean trouble in a number of ways, right? This could certainly mean trouble in a number of ways, and this is long term, spanning out to 2028. But again, we are sitting on the precipice that if 19,000 actually ends up breaking down, then this could very well unwind all the way up, leading to a very serious crash in probably 2026 to 2028. Right. So again, of course we have all of these news headlines when it comes to your Nvidias, your Googles, making all of these AI, making the AI, making pioneer achievements when it comes to AI driven systems and things of that nature, right? But again, the big question that beckons here is if you tariff all of these countries, right, and it costs these companies more, the prices of these companies, it costs these companies more to do the exact same thing, thus causing them to raise their prices to offset it. Then how much is this really sustainable in the grand scheme of things? I made a post on Twitter back in August of last year, where we basically said that Nvidia is the gargantuan leader of the AI bubble itself. Why? Because its revenues, when it comes to its drivers and everything, sure, it's great, but again, it has not moved too well in relation to its PE right now. Okay. Now, we're not going to get too much into that, but one thing that I want you to focus on currently right now is that, again, this was made August 11th and it just hit our price target long term. The AI bubble is over, but progress still needs to be made. It's a $20 stock. Pre-stock split, this essentially means $200. $93 first, and then $160, then the abyss. And again, just showing you guys the work that we essentially did prior to this. You know, this is what it is that we essentially had. Now, if we actually take some time to look back, and again, we've updated this, right? Perfect. Where is it? We've updated this, right? And just to really show you guys the bigger, right? We can see now that our target has hit a year later, but it hasn't, you know, but now the question beckons is, where does it go from here? Between a combination of the interest rates, between a combination of the tariffs issue, considering the fact that they get majority of their semiconductor supplies from Taiwan, where does Nvidia decide to go from here, as well as the carry trade? And in the event that it does go down, how much will it impact the markets as well? Okay. So again, yes, we have great news. We have amazing news when it comes to what's happening in the world. But again, there are a number of things that are currently unfolding in real time process. Now, the question is, what is it that you can do to actually take advantage of this in any way, shape, or form, right? Well, there are a number of ways of how you can do this. As it currently stands, if you don't know, right, there's an opportunity for you to take advantage of the overall markets in the event of a downturn. Now, again, if you're unaware about what this means you would have to be a trader and trade what are called puts. If that's not your kind of speed, do not worry. But just know, you know, the run of the mill, the most common thing that majority of people do, especially if you're a trader, they simply just take advantage of the downside price action when it comes to being able to make money when the markets fall, right? Now, personally, me, I like to try to play out quarterly time frames instead of doing the whole day trading thing on the side of options. Why? There are a number of things that you got to worry about: time decay, you know, fluctuations. And again, it's just better. That's just been a lot more efficient. I think that's a lot better for beginners. So again, if you're an options trader, you're an individual kind of looking at this to see where in the world that you can actually take advantage of this, then this is going to be something for you. Okay. Secondly, after that, the second way, before I actually go into breaking down what our targets are after this, right, is if you're anything like me personally, I'm a futures trader, then you can just take advantage of this on a day-to-day basis. And for all of my investors out there, this is where your time starts to shine in a number of ways. Why? Because of the fact that we have the you know, a number of macroeconomic events that are happening in real time. Going back to the Japanese yen, commodities, in my personal opinion, are probably going to be your biggest asset long term. So I'm talking about your oils, your golds, and your silvers. And one thing that we can personally say right now, oil is probably going to be one of the bigger ones to really boast about in the coming years. And the reason why is because, for those who don't know, oil is priced in Japanese yen. So as the price of Japanese yen increases, so too does oil. Now, as you guys can see, we have our annotations here because this is actually from our from our wealth compound kit. So if you're unaware, again, the link to the wealth compound kit and everything that we have within it, from our projections and what our main stock picks are all contained in there. All targets, all deductions, and notes concerning what it is that we're focusing on, you know, between now and 2030. Okay, so just to give you guys a little sneak peek, as you can see, Occidental Petroleum has experienced major growth cycle from post-COVID-19 era in 2019 to late 2022. We believe, however, it has entered its lag phase followed by a massive growth for the coming years. We believe the strength of the growth cycle not only comes from the company's industry and sector as an energy and oil producer, but also venturing into the mineral space, producing Terra Lithium due to Warren Buffett's subsidiary Berkshire Hathaway Energy entering into a joint venture with the company. For these findings, we believe that the company stock can grow to $100 once again, but go beyond towards $150 to $200 plus a share in the future. And what it is that will actually take some time to do, right, is if we actually take some time to go over here now, we can actually see that Occidental Petroleum has recently hit our target back when we actually had this jotted down at $56.98. Again, our $37 was our target for the lag cycle, as you can see, and $84 is our minimal target for Occidental Petroleum. Again, the last time that we updated this, and like I said, this is a part of the Wealth Compound Kit. Feel free to get your own copy to have all the information of what it is that we're going to be investing in and choosing from in order to compound our wealth, right? But again, this was updated April 27th of this year, where now we are making our way towards that area that we're speaking about right now, that we're speaking about right now, slowly but surely over the coming years. Okay, so if you're an investor, oil is going to definitely be something worth taking a look at. In addition to that, you also have your hard assets like gold and silver. So again, this is also another one that is a part of our Wealth Compound Kit, where currently right now gold is sitting at about $3,400 an ounce. Now, we caught this and we've been tracking gold, especially in the Wealth Compound Kit, as far back as I believe $2,500 an ounce. So again, this is the original chart that we had. Our minimal target for gold is 5,000. Max min, right? Or minimum max, excuse me, is 8,000, right? So if we actually take some time and we've gotten more data and information on this, right, you can actually start to see that gold is particularly, and let's get this out the way real quick. We don't need to use the 3-month, but gold is in a very huge super cycle as it stands right now, and we see that we're looking at something similar towards 2008 happening, and that would cause a lot of people to panic in some way, shape, or form. But the magic starts to happen afterwards, where we start to gain some serious traction into what could potentially become the golden age for hard assets. Now again, our minimum target for gold is 5,000. Our minimum max for gold is 8,000, and of course the max following the charts that we have here is actually over $10,000 an ounce on gold. Okay, why is this? What's going to potentially allow for this to happen? The reevaluation of gold itself, as well as the continuing diminishing of the United States dollar as well. Okay. In addition, silver stands to carry the exact same thing as well, right? So again, this is a lot more cleaner. But again, gold stands to go anywhere between 50. I'll probably say $40 to $50, right? Minimum when it comes to it. But again, this also has something very nominal as well. If I can, and I'll just go ahead and update we'll probably push this and just being very generous at probably your 300s, just to simply follow the same formula when it comes to our charts for the time being. Okay. As a matter of fact, let's double check this. Okay, perfect. So that's the exact reason why we had it like that. Let's go back and let's go to the 1 week. And now that matches up. Gotcha. Okay, so maybe we don't need to change that. But again, these are longer term. These are spanning out years in the future. But again, this is why it's super, super important for you to understand how to take advantage of these. Because again, at the grand scheme of all of these, right? Well, what's the possibility that can happen currently right now due to all of these things that we're talking about, right? Well, as you can see, all of the things between tariffs, between interest rates, between between the high evaluations on the entire markets, everything is screaming for a serious 7 to 15% pullback on the S&P 500, which would ultimately lead us to, I'm just going to highlight this real quick to make sure very clear. This would ultimately lead us to about 5,800 minimum. Okay, so again, this is super important. It can potentially lead us to 5,800 minimum in a number of days. And the thing is, all it takes is one bad thing to unravel this in order for it to happen, whether it be geopolitical tensions between the Middle East and Israel, whether it be tariff announcements. Again, we caught some rattling in the markets over the past week due to the issuance of tariffs on Canada and Mexico, and we have a slew of additional tariffs on the other countries that we mentioned today, this morning, over the course of the weekend. So we will see how the markets are essentially going to react to those the coming week, right? But again, this is everything that you need to be aware of. And if I can leave out with this again, one last thing, you also have the S&P 500 volatility index, or the VIX. Do I see now? And this is what's very peculiar. The last time that we were sub 13 was post elections, and we got post rally, and we did not even last that long. And then afterwards, we have not been below sub 14. We haven't been below sub 15 rather since February, right? And we're right back at those similar levels. So again, something big is coming around the corner, and it's looking like a 7 to 15% drop on the overall markets itself. The Dow Jones Industrial is teetering at it with a triple top. Okay, the Nasdaq Composite is overextended, and we're sitting here currently right now where we are sitting at some major resistance for the S&P 500. Okay, so again, if you're a kind of individual who is an options trader, definitely feel free to assess and take a look at puts on a quarterly basis. This is personally the best way of how I would prefer to go about it. Have them scheduled out 3 months in advance and shoot for a nominal target that best suits what it is that you have. But just know it's not investment advice. I'm not a financial advisor. Please do your own research and have full accountability for the actions and the decisions that you decide to make. Okay. If you're a futures trader, by all means, feel free to join our community where we have daily live alerts on futures that you can also take advantage of on the side of options as well as investing. And if you're an individual who's just a clean straight investor, then commodities is going to be the best way of how you can actually take advantage of this. But let me know what you guys think about this. Let me know if this is something that is helpful to you guys. But again, these are going to be the things that you're going to need to know, and we're going to be coming back more and more to give you more to help you make smarter investment decisions. So that's all I got for you guys today. If you like this video, definitely give a like, definitely give a comment. Be sure to subscribe so you don't miss out on the next video. And I'll catch you guys in the next one. See ya.